A shift in mindset, much more mature than it was 10 years ago, but still an emerging ecosystem. Globally recognized innovation hub, overnight success, 10 years in the making kind of thing. VC is loud. Venture capital is one tool in the toolkit, but it's not the only tool. And the thing with venture capital is that once you choose to go down that path, it's a one-track path. Non-dilutive capital is not just about the capital, it's about the resources that it unlocks for the business. You can actually go further with less.
Welcome to Season 6 of Between Meetings. This season is all about Alberta's investment landscape. I'm your host, Marian Danko. In today's episode, I'm speaking with Andrew Browne, co-founder of Thin Air Labs. Andrew has spent over a decade helping founders design, fund, and scale companies. He helped raise and deploy a 20 million seed fund and build the Fund and Catalyst practice, which has supported startups in securing more than 80 million in non-dilutive capital. Andrew, I'm thrilled to have you on the show. Thank you so much for taking the time.
Of course, happy to be here.
You've been a part of the startup ecosystem here in Calgary for quite some time, from advising founders and building your own company to working with a number of incubators and accelerators and investing in others. That gives you a unique perspective. How would you describe startup ecosystem here in Calgary today compared to where you started?
Yeah, so when I think back to, let's say 10 years ago, there wasn't much of an ecosystem here. There was, obviously entrepreneurs building businesses, but it was very segmented and siloed, and some success stories brewing in the background, but not a lot of community events or opportunities to come and share learnings with peers and learn from each other and all of those types of things. So when I think about where it's at today, I would say much more mature than it was 10 years ago, but still an emerging ecosystem. So there's a lot of the pieces and the ingredients that are required to create an innovation hub, like a globally recognized innovation hub. And I think we're starting to see that all come together, and we're starting to see businesses get built and created and grow and scale all the way through to exit and everything in between. And so it's an exciting time to be here. Building companies. I think it's a great city, a world-class city just in general to live and to raise a family and to be. But even more so now as a builder or someone that's looking to build a company or an entrepreneur that wants to bring an idea to life, it's an exceptional place to do that, just because of all the access to capital and other types of resources, talent, early customers that you can get product into and test and validate. And I think the biggest thing that I've seen over the last 10 years is a shift in mindset from entrepreneurs who are really ambitious and want to build global scale companies right from Calgary and don't want to compromise on where they want to build from. So it's an exciting time.
Awesome. In one of your recent posts on LinkedIn, I'm a big fan of LinkedIn. I think you too as well. So it's a great place to build connections and to look for information as well. You said that too many founders get caught up in the VC culture without being clear about the outcome they're trying to build. So what actually do you mean by that, and how we can get founders more intentional about type of business they're trying to build?
Yeah, it's a good question. So in my work, I've been in the founder seat. I've raised capital. I've raised venture capital. I've sourced grants and favorable loans through government and capitalized my businesses in various ways. And what I've learned, and I've also advised companies on the other side and been in support of investments going into those types of companies. And what I've observed is there's lots of different types of companies. There's lots of different ways to capitalize businesses and set them up for growth. And venture capital is one tool in the toolkit, but it's not the only tool. And it's far from that. There's lots of different mechanisms and ways you can capitalize a business for growth, or just to create a steady growth and more sustainable type of company. And I think what I see a lot of is VC is loud, it's exciting, it's easy to, there's big headlines and rapid growth, and all of those headlines are typically like overnight success, 10 years in the making kind of thing. So there's a lot that goes into building a company in the background before it becomes a headline or a success. And venture capital is just one tool that you can use to build, to capitalize a business. But it's a very specific tool. It's designed and in the early days was really meant to help de-risk very complicated or kind of challenging technology or to scale a business really, really fast, where speed is the differentiator in a business model. And so venture capital is a good tool to solve those problems, but it's not necessarily the right tool for a company that might want to build a $10 million or a $20 million revenue business and capture maybe a more niche market. And there's nothing wrong with a building business like that. And so I see a lot of entrepreneurs just not being clear about the outcome they're trying to drive, and therefore making the wrong decision about how they choose to capitalize the business. And the thing with venture capital is that once you choose to go down that path, it's a one-track path. You are then responsible to your investors and the people that you brought onto the cap table to grow as fast as you can, sometimes at the expense of decisions you have to make in your business that might not be best for a different outcome. So yeah, that's kind of what I mean by that. I think being clear from the onset of what you're trying to accomplish and the outcome you're trying to drive, both personally as an entrepreneur and as a founder, but also professionally as a kind of a business operator, really makes the path and how you capitalize that business much clearer and strategic. So instead of just kind of capturing or grabbing capital from wherever you can find it as you try to build, you can be much more thoughtful with how you capitalize the business, and ultimately kind of balance the pros and the cons that come with different types of capital from different types of investors.
You co-founded Thinea Labs, which takes a unique approach combining venture investing and services. And one of those service lines is a funding catalyst, helping founders to get non-dilutive funding. That makes you the best person to talk about non-dilutive capital. And let's unpack what is non-dilutive capital and what are the main types of non-dilutive capital that founders usually tap into.
Yeah, so non-dilutive capital, the term just very literally means it's capital that you can bring into a business that doesn't dilute the shares in the company, so it doesn't cost you equity. Doesn't mean that there's not a cost to it. Obviously, there's a process you have to go through to identify the right grant or the right program. There's time that it takes to actually put those applications together, to follow up on them, to report on the progress of them, to scope the project that you're actually going to be asking for money for. Right, so it's not that it's free capital, but it doesn't dilute the cap table, and I think that that's a really useful tool. Again, one tool in the toolkit when you think about all the different forms of capital you can bring into a business to grow it. And there are some common ones, grants being kind of prolific in different areas, especially for different types of companies, specifically technology companies, technology grants, R&D grants. There's tax credits, programs like SHRED in Canada, and the equivalent in other places and jurisdictions around the world, which can be really useful as well. But only if you think strategically about how those programs and vehicles fit into your overall capital strategy. So the best advice that I can give to people that are thinking about how to leverage this type of capital is to think of it as one part of the stack. And think about how it can be leveraged one way or the other from equity, potentially commercial loans or other types of debt capital that you can bring on, and these other types of capital. So it's not a one or the other. It's how all of those things fit together to capitalize the business and set it up for growth. So I kind of mentioned a couple common programs there, but the thing that I see a lot is companies, and from our perspective at Thin Air, and the reason that we built out a service line around it was, if we were putting equity capital into a business, we thought to ourselves, well, what are all the ways we can use that we can leverage that capital to help a company go further without having to continue to dilute? So the traditional venture capital playbook is raise a round, grow as fast as you can, raise another round, always catching up to the kind of growth expectations you set on the last round. And I think that that's the right path for certain kinds of companies. But even then, you might be able to, let's say you need $2 million to capitalize the early stages of a business. Not all of that has to be equity. If you raise $1 million in equity and you leverage that $1 million to bring in $1 million in grants and tax credits, now you have $2 million worth of buying power, but you only sold $1 million worth of shares in your company. So you're able to maintain more control. You sell less of your company. And one of the things that I see a lot that I think should be talked about more is how expensive equity capital is to a business, especially in the early days when there's a lot of risk still in that business. When you play that out over time, and you see a company become ultimately successful, you look back on the equity that you sold in the company in year one, and it's multiples more expensive than if you were to be a little bit more thoughtful and strategic with leveraging other forms of capital that might have a shorter term cost to them, or might take some time or focus or energy away from kind of the core of the business, but might be the right tool at that time then if you kind of think about it holistically.
What are the most common mistakes you see founders usually make, whether in timing or story or how they actually use the funds?
Yeah, so you mentioned a couple points there. I think one of the most common mistakes I see is timing, but I think that's a result of just not being strategic or thoughtful with the approach, and not thinking about the plan as a whole. So if you're reacting to programs that you see get announced or that launch, or you just kind of stumble across in your journey, then it's kind of like a mad dash to pull resources from other places in your business to focus in on getting an application in, scoping it and kind of trying to fit it into a strategy that you've already developed, as opposed to thinking about the strategy right from the beginning and all the different ways you can capitalize on that strategy or capitalize that business plan from day one. So if you're really thoughtful and you kind of build the strategy early and think about how non-dilutive fits into that strategy right from the get-go, and continuously over time, you can be much more proactive with the types of capital you pursue, and much more efficient with your time, because it's part of the plan and it becomes part of your quarterly objectives or annual objectives over time, as opposed to just reacting to it when it becomes available, or in some cases getting to a position where you have a cash shortfall and maybe you have to bridge yourself to another round of equity capital, and you start kind of grasping at all these different things around you, but that could actually be a detriment to the plan that you might have otherwise done if you didn't have to be reactive to it.
And also, common situation that I see quite often, that founders basically, once they figure out how to get non-dilutive funding, grants, they just keep going after them, tweaking their business models, tweaking the approaches, and just to make sure they fit in the next grant. So what are your thoughts on that?
Yeah, I think that's a dangerous path. Like, ultimately, the goal of building a business is to create a sustainable business over the long term, right? And grants are not, like, granting agencies and funding agencies are not your customer. They are a capital provider that can help capitalize a business. But if you start thinking about them as a customer, I'm going to build this product line because it fits into this grant program, or I'm going to pursue this commercialization strategy because it fits in with this program, then that, like you said, Marion, you end up kind of pivoting your business in a direction that might not actually be the right direction. So I never recommend that, and I always recommend being again, thinking about it strategically as one tool in your capital stack that you can think about longer term as part of the holistic strategy, and not be reactive to it, and not kind of pivot or adapt your business in a direction just to be able to secure the next grant. The same is true with equity, right? You don't want to have to tell a different story if it's not true to what you're trying to do and build just to get capital in. And that should be consistent, that narrative and story should be consistent across different capital providers, whether it's equity investors, venture capital, more patient capital, banks, loans, commercial debt, any of those things. If you think about it in the form of an application, that story should be similar, or very much aligned with how you're raising capital from other places as well.
And you already touched on the, I guess, balance between equity and non-dilutive funding, but if you can go a little bit further and deeper on that. So what is the right mix, and when can leaning too much on one side actually can hold the company back?
Yeah, that's a good question and a good way to frame it. I think I think it's different for every company, but I think the use of proceeds is different for different types of capital that you bring in. So, for instance, equity might be the most flexible choice of capital. You raise money and you sell shares, and the money hits your bank, and now you can do whatever you need to do with that capital. Grants are more targeted and specific to certain things that you've set out to do or in the application. So you've scoped a project. You said, I'm going to move this technology from TRL 2 to 4 or 4 to 6 or wherever it might be. And therefore, that money has to be used for those purposes, right? So it's a little bit more rigid. But if it's a project that fits into your overall business plan, then it's a form of capital that you can inject directly into the stuff that you're going to be doing as part of your overall business plan. While you have kind of a backstop of equity capital that you can use for all the other things that OpEx that goes into building a business. And so it is a balance, and it's not, it's something that you really want to be thoughtful and create a strong strategy around in terms of how all of those things fit together. And anytime I'm thinking kind of further out into a business and like what's next for it, I think, 12 to 18 to 24 month objectives. We want to go from A to B. How do we, what forms of resources or capital are available to us as a whole to help us get there, and then narrow in on executing that as part of the plan, right? And so often it might start with, I'm going to go out and raise $1 million in equity capital, and then I'm thinking about, if I get the $1 million in equity, then I can use that as leverage to get this $200,000 grant over here. I can get wage subsidies to hire on some more resources to help us move faster. And that kind of goes into the overall strategy. And that's actually another important point is non-dilutive capital is not just about the capital, it's about the resources that it unlocks for the business, right? So it's not necessarily money in the bank, but it's going to help subsidize the costs that you're going to incur and should incur, and if you're thoughtful with where you're investing in your business, but it's going to subsidize that cost so you can actually go further with less.
Looking at the broader capital landscape, are we going into the direction where the new models and new mindsets will be implemented in how we fundraise and build companies?
I think so. I think you're already seeing that. I think entrepreneurs are incredibly resilient and adaptive, right? And resourceful. So when you're building a business, you're kind of looking at all of the different things around you that are available from a resource perspective, including capital, and you're saying, what's the best stack or mix of options here to help get me from where I'm at now to where I want to be in 12 months or 24 months or further. And then you kind of pull it all together and you execute towards that plan and strategy. And so when there's a really frothy market and there's a lot of venture capital available, and you can walk down the street and in a hub and bump into someone that might be able to write $100 million check into your company, then that might be the best option because it's just so accessible, and the money's available. When money tightens up, and like what we've seen over the last couple of years, then entrepreneurs still want to build their business. They just have to think of other ways that they're able to do that and capitalize it to set themselves up for success. So I do think that you're seeing more creative approaches with that. I think that if you're able to kind of learn some of those skills or find partners like Funding Catalyst or other groups and kind of around you, other smart people that have kind of approached capitalizing a business in this way, then I think that you can really be creative with how you approach that and maybe sell less of your company or maybe move faster than you would be able to otherwise. And I think, I think about it as what's the right mix of tools and resources that is going to help me achieve my outcome. And so that goes back to the first part of the conversation, which is what outcome are you trying to create? And then build your business and capitalize your business around that objective.
Andrew, thank you so much for your insights, and I really look forward to see what next for you.
Thanks, Marion. It's great to be here, and great segment. I love listening to all the other episodes, and it's a goldmine of insights. So thank you for doing it.